The global economy is slowing. The only question is how mild or how severe the coming downturn will be. What is the biggest downside risk to the US economy? Has China decided to sacrifice short-term growth in pursuit of its tech ambition? Why has Germany's economic slump lasted so long? And why is the Olympics not giving France an economic boost that it sorely needs? Data released this week showed that US GDP growth accelerated in the second quarter to an annualized rate of 2.8%, up from 1.4% in the first quarter. Inventory build was an important driver, adding 0.8 percentage points to GDP growth. But so was government consumption expenditures that grew faster than household consumption expenditures for the 8th consecutive quarter. Defense spending increased by 5.2%. Another key driver was private domestic investments in equipment that increased by a whopping 11.6%. In particular, spending on information process equipment jumped 12%. Spendings on defense and AI directly contributed 0.4 percentage points to GDP growth, but together with indirect contribution, my guess is that they accounted for at least 20% of GDP growth. Is this sustainable? There's no doubt that AI has prolonged the US economic expansion, as evidenced by the 50% growth in the combined earnings of the Magnificent Seven in the first quarter. But as I explained last week, we should be careful not to make too much out of this, given that huge investments in expensive AI chips by the likes of Microsoft, Amazon, Google, and Facebook hit their income statements very slowly through depreciation. We have little evidence at this point that these investments will pay off in the end. This week, Alphabet stocks took a bath after the company announced higher depreciation costs for its investments in technical infrastructure in the next quarter. Meanwhile, companies as diverse as Verizon, UPS, and American Airlines cut their earnings guidance this week. With the labor market already slowing, this does not bode well for the hiring outlook in the third quarter. What about defense spending? Regardless of who will be the next US president, America's huge budget deficit, currently near 7% of GDP, is not sustainable. With the current excessive reliance of the US federal government on Treasury bills for funding the budget deficit, the gross financing requirement in 2025 could be more than $3.5 trillion. As I argued last week, this is one reason why I think the market is overestimating the chance of growth-spurring fiscal stimulus under a potential second Trump term. My bottom line, election uncertainty will weigh on the consumers and businesses alike over the next 3 months. A bursting of the AI bubble is probably the biggest risk facing the US economy. But the huge US budget deficit will seriously constrain the scope for both fiscal and monetary stimulus in the next downturn. While US GDP growth doubled in the second quarter, Chinese GDP growth halved. On a quarter-on-quarter basis, Chinese GDP growth fell to just 0.7% in the second quarter, from 1.6% in the first. Chinese consumers are pulling back, with June retail sales growing only 2%. Chinese consumer confidence, which has been sliding up late, is just a hair away from its record low reach in 2022. This week, European luxury makers LVMH and Richemont both reported falling sales in China. Meanwhile, declining Chinese home prices is accelerating, including in first-tier cities. Mortgage applications have collapsed, and the floor space of residential buildings under construction fell to an all-time low last month. Money supply growth is slowing at an alarming rate. What it says to me is an implosion of demand for loans. The fact that the much-awaited communique of the third plenum of the Chinese Communist Party Central Committee released this week contained no new initiatives for addressing the housing downturn is telling. Is it possible that Beijing has decided that the problem is too great and the policy ammunition at its disposal too small? As I pointed out in a previous video, Chinese developers are sitting on at least 400 million square meters of completed residential units, worth roughly $2 trillion that they're struggling to find buyers for. Even if the government wants to help, its ability to do so is constrained by the poor state of public finance. China's primary budget deficit will be even greater than that of the US and only smaller than that of Japan this year, according to the IMF. Is it possible that Xi Jinping has thus become resigned to letting the bursting of the housing bubble to run its course? Frankly, I don't know what else to think. Apparently, Chinese equity investors agree with me. A CSI 300 sold off sharply this week and is once again teetering on the important 3,400 level. The third Plenum's communique suggests that Beijing will devote its limited fiscal resources to play catch-up to the US in their tech race. The implication is that Xi has chosen long-term growth over short-term growth. Whether this strategy will pay off or not in the end, all I know is that risk to Chinese near-term economic growth outlook is definitely to the downside. And downside risk will grow as the global economy slows and tariffs bite further into China's key strategic exports like cars. The July European manufacturing PMIs released this week make it very clear that any economic momentum that the three biggest Eurozone economies might have built at the start of the second quarter has completely fizzled out. German business activity fell to a 5-month low. Incredibly, the German economy has been in a slump since the start of the Ukraine war. The fact that the slump has lasted so long suggests a permanent hit to Germany's structural growth rate from the war that the Germans have Biden to thank. But we're not going to go there now. And then there is France. If history is any guide, the Summer Olympics should be already providing a big boost to the French economy. The fact that this is not the case is worrying. Not only both hotels and airlines are cutting prices as tourists are staying away, political uncertainty in France remains high even after the elections earlier this month. I argued a few weeks ago that a gridlock would not be better for France or for the market than a victory for the populist right. I'm still holding to this view. Macron joined forces with the far left to deny victory to the populist right. As a result, National Rally came in third place in the French election despite winning the most votes. This week, Macron made an enemy out of the far left too, by rejecting his candidate for prime minister. As a result, the left and the populist right are now in talks about joining forces to undo Macron's unpopular pension reform. I think the market underestimates just how much the French left and the populist right have in common when it comes to economic policies. A vote on reversing the reform may not be held until September, but Moody's warned earlier this month that canceling the reform will precipitate a downgrade. The so-called post-Olympic Valley effect refers to an economic slowdown following the event. France will be no exception, unfortunately, in 2024. Except the coming slowdown will only compound the French fiscal problem and stoke political tension further. Honestly, I struggle to see a way out. France is on a slippery slope. And France is too big to be bailed out by the rest of the Eurozone. The IMF is forecasting the world economy to grow 3.2% this year and 3.3% in 2025. I think its forecast for 2025 may be a bit too optimistic, even though interest rates are set to fall globally. I see two major downside risks in 2025. One, the bursting of the AI bubble. Two, a fiscal crisis. Many of the largest economies in the world are running unsustainably large fiscal deficits. I think this will come back to bite the global economy in the ass next year. In the case of China, its weak fiscal position is already constraining its ability to shore up the battered housing market. In the case of France, its large deficit and potential further deterioration are already starting to drive up its borrowing cost. The only reason why the huge US budget deficit has not had a bigger impact on the US economy is because of the dramatic reduction in the average duration of Treasury issuance by US Treasury under Janet Yellen, America's fiscal sorcerer. The problem with the reliance on bills is that they need to be rolled over constantly. America's gross financing requirement next year will be $3.5 trillion or higher. Whether the US will find easily buyers for $3.5 trillion of Treasury securities is the biggest open question for 2025. If it doesn't, it will have a negative knock-on effect on all fiscally challenged countries. I see gold as the best hedge against this fiscal risk. Thank you for listening.